Hello, my name is Rowana, and I am your host of this series of courses. Welcome to today's beginner-friendly course on investment. This video will cover a comprehensive introduction to investing, focusing primarily on the stock market, with additional insights into bonds, mutual funds, ETFs, and diversification. Let's start the journey of learning about investing and growing confident on making informed decisions to build your long-term wealth. Hey! Ever wondered how to make your money grow? Welcome to the wild world of stocks. Stocks are like owning a tiny slice of a company. When you buy one, you're helping that business expand while betting on its success. In return, you might earn profits as the company grows. Historically, stocks have been the rock stars of investments, delivering higher returns than most options over time, like an average of 11% yearly for big markets. But buckle up. Prices can swing wildly. Think of it as a roller coaster. Thrilling, but not for the faint-hearted. Investing in stocks is a powerful way to build wealth, especially for retirement, if you're ready to ride out the ups and downs with a cool head. Imagine owning a piece of Apple. How cool would that be? Stocks make you a part owner of a company, and here's how it works. Each stock or share is a fraction of the business. If a company has 1 million shares and you own one, you've got 1/1,000,000th of it. As a shareholder, you get perks, like voting on big decisions, such as who runs the company's board. But, in reality, you're choosing from a pre-picked list, kind of like voting in an election with limited candidates. This setup can favor company insiders, so stay sharp. Owning stocks also means you might get dividends, cash payouts from profits. It's a way to share in the company's success while helping it grow, but always keep an eye on how the business is managed. Ever dreamed of owning a piece of Disney's magic? Let's dive into what a real stock looks like. Disney's stock, for example, trades on platforms like Yahoo Finance or CNBC. One awesome perk? It pays a dividend, about $1.72 per share yearly. That's like getting a small thank you check for being an investor. If you own one share, you pocket that cash annually, and the stock's value might climb over time. Disney's price isn't just a random number. It reflects what investors think the company will earn in the future, from movies to theme parks. But here's the catch. If Disney hits hard times, like bankruptcy, your investment could take a hit. Still, your risk is capped at what you put in, making stocks a calculated adventure. Want to know if a stock's a steal or a trap? Valuing a stock is like cracking a treasure map. Here's a simple trick. Divide the expected dividend by your required return minus the company's growth rate. Let's try it with Disney. Using a site like Seeking Alpha, we find Disney's dividend is $1.72, with a growth rate of about 7.8%. If you want a 10% return, the math suggests Disney's worth around $83. But if it's trading at $114, it might be overpriced. Unless investors expect faster growth, like 8.5%, bumping the value to $124. The trick is studying the company's profits and growth to decide if it's a smart buy. Get this right, and you're on your way to savvy investing. Ever felt like the stock market's a wild storm? It can be. Over 60 years, the S&P 500 has averaged 11% yearly returns, but it's a bumpy ride. Daily swings of 1 to 2% are normal, and big drops, like 10% in a month, can happen. Imagine earning $50,000 a year and losing $500 in a day if your $50,000 portfolio drops 1%. Ouch! The secret? Don't panic. Stick to your plan, like a surfer riding waves. Emotional selling during dips can wreck your gains. Set a fixed investment amount and hold steady, adjusting only for long-term goals or expected returns. Markets reward patience, so focus on the big picture. By staying calm and invested, you're more likely to see that sweet 11% average growth over time. Ready to jump into investing? First, you need a brokerage account. It's your ticket to buying stocks. Firms like Schwab, E-Trade, or Morgan Stanley offer these. Full-service brokers charge more, think $30 to $100 per trade, but give personalized advice and research. Discount brokers like TD Ameritrade keep costs low, $5 to $10 per trade, with fewer frills. Want it even easier? Try a robo-advisor like Betterment or Wealthfront. These apps ask about your goals and risk comfort, then build a portfolio for you. No stock-picking stress required. They're perfect for beginners and often come with low fees. Pick a broker that fits your vibe, but here's a pro tip. Trade sparingly to save on costs. With the right account, you're set to start building wealth like a pro, minus the overwhelm. Confused about what to invest in? Let's break down mutual funds and ETFs. Mutual funds are like a pro chef's dish. A manager picks a mix of stocks to beat the market, charging fees 0.25% to 1.5%. They're great for retirement but can be pricey. ETFs, on the other hand, are like a market buffet. You buy a slice of an index, like the S&P 500, with lower fees, 0.1 to 0.2%. They trade like stocks and aim to match, not beat, the market. Watch for tracking error, how closely an ETF follows its index. Lower is better. Both are solid, but ETFs save cash, while mutual funds offer expert picks. Choose based on your budget and how hands-on you want to be. Stocks too wild for you? Bonds might be your jam. They're like lending money to a company or government who promise to pay you interest yearly and return your cash later. Key features: par value, price, coupon, maturity, which is when you get paid back, and yield, which is your return. Bonds come from corporations, governments, or cities. Ratings like AAA, which is safe, to junk, which is risky. Junk bonds pay more, but are dicier. Think of bonds as a steady paycheck versus stocks roller coaster. Pick based on your risk comfort. Safer bonds for stability, or high-risk ones for bigger rewards. Understanding these basics helps you balance your portfolio with less stress and more confidence. Scared of losing money in stocks? Here's a game changer: diversification. Stocks are risky, half lose value yearly, but a few superstars drive big gains, like 11% annually for the S&P 500. Miss those, and your returns tank. Diversification means owning a wide mix of stocks to catch the winners. Think of it like a bag of chips. Most are worth $10, but one's $100. Own a piece of every chip and you average $19. ETFs or mutual funds make this easy by tracking the whole market. This cushions you from big losses when some stocks flop. Stay long-term to ride out dips, and don't bet on one stock. With a diversified portfolio, you're set to grow wealth steadily, turning the market's chaos into your financial win. What is the key takeaway? Investing in the stock market offers significant long-term growth potential, for example, 11% annual returns, but it requires understanding the basics of stocks, bonds, mutual funds, and ETFs, as well as managing risk through diversification. Beginners should start with a brokerage account, consider low-cost ETFs, and focus on long-term goals while avoiding emotional reactions to market volatility. Careful valuation and cost management, such as low expense ratios, minimal trading, are critical to building a secure financial future. In our next video, we will talk more about insurance. See you soon.